Amit Rastogi from Gurgaon, sir. Is also chartered accountant. We are going to be learning today first balance sheet and IT returns of NRA of repatriation. Before going to the further session, okay, now I request all the members to raise the motto song as a mark of respect. It is not required to stand as a mark of respect to put your right arm at your heart.
Geographically, the
Any issue?
No, madam. 1 second.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यति कश्चन एतद्द्वैता
Thank you each and everyone. Now I request our branch chairman, chairperson CA Gaddam Shrita Shirini Garu, give her welcome address.
Yes, sir. Today's speakers CA Amit Rastagi and colleagues at Managing Committee and Branch Chairman CA Godavati Srinivas Rao Garu and other fellow members. Very good evening to one and all. My hearty welcome to you all for the third day of virtual series of VCM and FEMA and international taxation. Hope you all have benefited from the last two sessions. Today's topic is first balance sheet and IT return of NRA after repatriation, which is a very important topic. As an NRA returning to India should have a well-thought plan, financial planning. Making out any impulsive decision will have definitely will have adverse effect. NRA returning to India will have can save taxes on their overseas income by following certain rules framed by the IT department. So NRA should definitely need the advice of a chartered accountant. And it will be a very important source of revenue for a chartered accountant also. Our speaker is having vast experience in handling such cases. So I request you all to have active participation and get benefited out of the session. Thank you, one and all.
Thank you, ma'am. Thank you, ma'am, for your kind words. And it's a time for introduction of our today's resource person, Amit sir. Now I request CA Jayant Upuluri, Chairman Sikasa of Vijayawada branch, give a brief about today's resource.
Thank you, Narendra Garu. So, Amit Rastagi sir has passed his CA exams and advanced diploma in international taxation from Chartered Institute of Taxation, UK. Coming to his industrial experience, he has over 18 years of professional experience in direct taxation, indirect taxation, and international taxation as a group or regional leadership role with Indian listed companies, Japanese and American Fortune 500 MNCs. He is currently a tax head at Rockwell Automation, US MNC. He had a word in past with companies like Panasonic, Sony, SSI Group, etc. He is a member of Harvard Business Review Advisory Control and has been serving as a technical reviewer with the Taxation Audits Quality Review Board of ICAI. He has been a part of ICAI study group of GST, and he is invited by Committee of Career Counseling of ICAI to promote the commerce education with special focus on CA course among a secondary, senior, higher secondary education and graduates, postgraduate students, as well as other stakeholders in India. He is acting as a resource person for conducting the investment awareness program for Committee on Financial Markets and Investor Protection of ICAI. Coming to his publications, he has written a book on income tax on salaries. He has regularly expressed his opinion on different tax matters in leading business newspapers like Business Standard, and regularly contributed tax articles in leading publications and contributions to Chartered Accounting Journal of Institute, Taxman, Tax Guru, etc., and so on. So by this brief introduction, I request Sir to take over the session, and it's privilege given by the branch to me to introduce Sir. Sir, please carry on, Sir.
Thank you, sir, for your kind words. I'm audible clearly now.
Yes, sir. Fine.
Okay. So first of all, I give you a thanks of what to the entire Vijayawada branch team, and especially thanks to G. Srinivasan sir, a past chairman, and current chairman Shri G.S. Sir, and secretary, and the entire team who has given an opportunity me to provide my comments in relation to this critical topic, which is a non-resident repatriate. What are the tax compliances specifically in relation to the tax return is going to be taken care by once he repatriate in India. So with that, let me share my screen and directly come to the topic. Just let me know once my screen is up. Okay, so the today's topic is the NRI after the repatriation, what exactly he or she has to do in relation to his tax return filing and income and first balance sheet. So we will be focusing specifically on this particular matter. It is not the once Indian person will move to outside and what compliances he or she has to take care. Our specific entire discussion will be happen in relation to a NRI who become a Indian resident after repatriation, and then what he or she has to do in India in relation to the tax return. So the entire discussion has been divided into a specific bucket where we will touch base specifically the residential status, a brief provision under the Income Tax Act, what are the nature of taxability of income, and then we will touch upon that what type of general income the non-resident will be have, whether it is a property related income or it will be a salary income or any other different type of income. Then in case of that particular non-residents, what exactly he or she has to take care in relation to the tax return filing. So where the special attention has to be taken care, where he has to adopt specifically a particular schedule, and then thereafter has to complete the rest of the tax return. And then we will also focus upon that exactly what exactly the requirement he or she will having, and in case if you have your client, so what are the specific documentation one must have before filing the tax return, so that the entire position will be very much clear. Then we will put more efforts in relation to the foreign assets reporting, which is schedule FA in income tax return. We will discuss more in detail about each of the clauses representing in the FAR schedule. Then we will also touch base on a very high level on tax return, which has been modified by the CBDT recently for the AY 22-23. What are the respective area that particular non-resident has to taken care. And then we'll touch base upon a gifting of assets. A non-resident who come down to India, he or she may have some assets outside India. He may or she have some property outside India. So whether he can give that as a gift to another non-resident or Indian resident, or whether the Indian resident can give that type of assets to that non-resident. So we will touch base on on transaction between resident and non-resident in relation to a gifting of assets. Then we will touch base upon in case he or she has some income outside India, that what are the double taxation effect will be there, how we will able to claim the benefit of tax which has already been withheld outside India. They'll and then quickly go through advanced tax provision. What are the things he or she has to be taken care well in advance before doing this tax return filing, and in case if there will be a non-disclosure or non-filing of tax return by the non-resident, so what are the consequences can be happen under FEMA, under Black Money Act, or under Income Tax Act. And then based on the experience what we have done it, we have complete entire maximum scenario that what type of different type of question can come in your mind when you are dealing with this type of particular situation. So we have bucket the entire list of question into a FAQ session where specifically we put down a list of a question where we will be discussing the different scenario, and then the proposed relation solution in relation to that particular question. So that is the agenda which we will going to discuss. Since I will be sharing my screen, so I am not able to see if any specific chat will become. So it will be better that if anyone can just in between just stop me and request for a particular query. Otherwise, we will take up the query at the end of the session. So that
Okay,
I
sir.
leave up to the participant and the entire team that how they will going to take up.
Okay, sir. We will take up at the end of the session.
Sure. So moving to the concept of the residential status, which is prescribed under the Income Tax Act. So there are generally three type of residential status. That is the provision which just we are briefing it to set the context that what we are exactly going to talk about. So one category is a non-resident, another will be a resident and non-ordinary resident, and third category will be resident and ordinary resident. So entire discussion today which we are going to talk about, it is in relation to a non-resident who came back to India and become a resident and ordinary resident. So entire dialogue or entire discussion will be happen to category C, which is a resident who become a resident in India after repatriate from the foreign country. So that is the three category has been prescribed under the act. I don't take too much of time or on discussing that how much number of days has been prescribed. So that is not the relevant thing as of for this particular seminar. Now coming to the next point, which is a taxable income. Generally, as we are aware that if a person become a resident in India, the entire worldwide income will be taxable in India. So whether it will coming from India or outside India, or whether he has accrued or deemed to accrue, entire income will be taxable in India. But in case of a non-resident, but which is not an ordinary resident, if he is an income outside India, that is not purview or a jurisdiction of the Indian Income Tax Act. Now the non-resident which come back to India, what type of different type of income generally he or she may have? He may be having a rental income from outside India. He may purchase some property outside India and then still generating that rental income. So we will talk more about that, how we will going to disclose this income, what would be the right way to disclose this information in the tax return. Another category will be the capital gain, which is in the shape of if he sold that house, that particular property, then there may be possibility to have a capital gain in India. Then what action need to be taken by that non-resident, that we will going to discuss more in detail later on. Then it may be possible he or she may have some shares or mutual fund outside India, where if he has sold after repatriate in India, then there may be a possibility of capital gain. There may be possibility of having a dividend income from those shares, and there may be a last category of interest income which he or she may having from his NRI account. So generally this 4-5 type of income that non-residents after repatriate in India get this type of general type of income. Now before proceeding directly to the tax return, what exactly he or she has to taken care. So there is an ITR form 2 which he or she has to be filled, wherein TTI schedule a total tax computation. There is a specific serial number 19 which has provided under the part B. So if that particular non-resident which become a resident in India, he or she has to select this particular tab before going to a further to apply any other schedule under the tax return. So he or she has to specifically mention whether he is holding any beneficial owner or any beneficial interest or any asset outside India, or whether he has a signing authority outside India, or if he has any income which are source outside India. Then if any of the clause is applicable, then rest of the schedule called schedule FA, foreign source income, schedule called TR, which is a tax residence, tax certificates, that all schedule will be applicable once he will select this particular tab in the TTI computation. So that is a particular first point before proceeding the tax return in relation to the non-resident. And once he select this particular option, then he or she has to specifically mention the detail in the schedule FA, which we will be discussing in after a couple of minutes time. Now, if you have a client who is a non-resident and having us and becoming a resident in India after repatriate back from foreign country, so what are the specific document one must have before filing the tax return? So example, we have plotted down a specific scenario where what type of income will be there and on which particular source of income that particular non-resident is generating, whether it is from the Indian source or a foreign source, and what type of document one must should have. Like in relation to a banking transaction, it may be possible that particular non-resident is still doing a business transaction or any other transaction with a foreign bank. So in that case, it is better to have a bank statement for Indian bank as well as the foreign bank. In relation to the salary income, yes, if after getting a after coming back to India, if he is employed somewhere in India, obviously you will have the form 16 from his existing employer. And in relation to the foreign employer, if he's getting a salaried income in past for that particular year where the return has to be filed, then the salary related information like his salary slip, TDS certificate, and other information where it has been established that he has earned a salaried income, that is the necessary document one must have. Similarly, for the interest income, if he is still getting some interest income from the foreign source, then it should have accompanied with the interest certificate, some investment document, and similarly like the India we have TDS certificate. If it may be possible, the different jurisdiction will have a TDS certificate in their jurisdiction. So we must request the particular your client in such a case that produce a particular TDS certificate. In relation to the rental income, if rental income that particular non-resident generating from the Indian source, then like we are aware about that it should have accompanying with the rent agreement, some tenant pan, and municipal taxes which has been paid. So these are the different scenario has been given. So I will not talk about what specific document is required. So that is the way which generally one before preparing a tax return should ask in relation to a different type of income. This type of document should be available before proceeding to the computation of his tax. So moving further, now we'll talk about more in detail in relation to reporting of foreign assets in the tax return. So as I mentioned earlier, the foreign assets schedule applies specifically to the resident of India, which after becoming a resident in India, only those non-resident which after repatriate, he or she will be eligible to file this particular FA schedule. Other particular nature of resident category are not eligible or they are not entitled to file this particular FA schedule. So FA schedule ITR 2 have a 6 or 7 component. We will talk more about what exactly each component and what information we have to put down in relation to each of the component. FA schedule part A1 is talk about specifically of foreign depository account. So if that non-resident who become a resident in India and he or she may having some foreign depository account. So this particular information has to be captured under the particular tab called A1. So we will discuss more about a specific information, like he has to put down his country name from where this depository account, that are the basic thing which is available. The main issue is, or main specific area is the peak balance. Now the peak balance, as per the notification or an instruction given by the income tax department, the peak balance has a definition where says that peak balance whatever appearing in the bank account in foreign jurisdiction, that has to be converted into the Indian currency. So and the main catch here is that we need to check what peak balance we have to be taken at the time of the investment or at the time as on the date of filing the tax return, which vary from year to year. So the instruction specifically mentioned the peak balance we need to consider whichever is higher at the time of investment or for the relevant calendar year for which particular year we are filing a tax return, where which particular balance will be higher, that balance we need to consider, and that balance has to be converted into the Indian currency. And Indian currency, the TT rate will be applied, which is prescribed by the SBI on time to time basis. So that is the main thing, which is specifically that what peak balance we have to be considered in relation to a foreign depository account. Now the another important point which I has highlighted in this slide is this information at what particular time we need to report. So this particular information from this particular budget, the law has amended and the department has given a particular circular and detailed instruction that this particular balance has to be applied as on the calendar year ending on 31st December 2021. So we will discuss with an example that what exactly does it mean, because in past the wording has been used is for the relevant accounting period, where now it has been replaced with the calendar year ending for 31st December 2021. So let's take an example that what does it mean. Say example, if you are filing a tax return for your client or for or any non-resident who is filing the tax return, then in that case, say example, if you are filing a tax return for assessment year 2022-23. So as per Indian law, the previous year will be 1st April 2021, 31st March 2022. Now, what does the calendar year ending 31st December 2021 means? That we have to consider the relevant calendar year is 1st January 2021 to 31st December 2021. So for when you are filing the tax return for the assessment year 22-23, you have to consider the calendar year, which is 1st January 21 to 31st December. Now, for example, a non-resident will come back to India. In situation one, he purchased some share of Dell Inc. in January 21. So January 21 is falling under 1st January to 31st December. So that means he or she has to mention this particular information in the tax return, even though he has already sold out of the share in that particular period. The definition of calendar year means that during the calendar year, if someone has that particular assets, then it has to be reported irrespectively whether that assets is as on 31st December is with particular SSAs is there or not. Now in another example is situation 2. If say example in January 22 that particular non-resident buy a Dell share in month of January 22, and Our calendar period is still 1st January to 31st December. So what does it mean? That still he has buy the particular share in the subsequent calendar year, which is next calendar year for the assessment year 23-24. For that particular acquisition, he will not going to report the transaction in relation to a share which is purchased beyond the calendar year. So let me summarize one more time. Earlier, every reporting under FA schedule has to be done on accounting period, which has been modified with assessment year 22-23. Now, each particular information has to given for the calendar year, and in those particular calendar year, if any foreign assets has been acquired by the non-resident who's come back to India, then particular information has to be reported in the tax return. And if any particular acquisition happen post those calendar year, then that information will be catch in the another years. Like the example which we have deal in this particular situation, that if any person purchase a share in year in the month of January 22, then he has to follow the tax return for 23-24. So moving to the another point, which is now the another area of foreign assets reporting is schedule have a component called foreign custodian account, which has to be reported under FA schedule as a point number 2. There is 2 or 3 specific point we have to understand that what does it mean of foreign custodian account. The custodian account, in case if anyone who is a beneficiary of any legal guardian, then he or she must have a custodian of that account, and that information has to be given. Now, the instruction of ITR 2 specifically talk about what does mean of beneficial owner and a beneficiary. If anyone fall under that category, that information again has to be shared in the ITR 2 in schedule FA. There may be there may be a position, or there may be a possibility that one at a time is a beneficial owner and also a legal owner of any specific transaction. Then the instruction specifically talk about, then in such a situation, we have to treat that particular person as a legal owner, and the legal and basis that the entire information under this particular tab foreign custodian account has to be mentioned. And this particular tab, whenever we will going to put down the information, this tab specifically talk about that what type of gross amount you are specifically earning, whether in the nature of interest, whether it is in the nature of dividend or any sale or redemption of any specific financial assets. So the classification of particular type of income is specifically mentioned in case if someone is getting a income from this foreign custodian account. Moving to the another point, which is another one is a foreign equity or a debt interest. So again, if anyone having as on calendar year 31st December 2021 for the assessment year 22-23, then he or she has to provide the information in relation to the foreign equity and the debt interest held in the foreign jurisdiction. Now, another point which the ITR form specifically talk about is that particular non-resident has to report his foreign cash value insurance contract as well as the annuity contract. So let's spend 1 minute here that what does mean of the cash value insurance and what does mean of the annuity contract means. So the annuity contract means where a contract under which the insurer agree to make a payment for a period of time determined in a whole or in a part reference to the life expectancy of one or more individual. Whereas the cash value insurance means an insurance contract other than the indemnity reinsurance contract between the two insurance company that has a cash value. Generally, this type of information are come into a employee or a person who work in a financial institution. So generally, this information will be captured by those type of assessee. And again, this information has to be captured as on calendar year ending as on 31st December. So there is no concept of accounting period which was earlier in the tax return form. Now this is done away. We have to use the same principle which we have discussed in a detail a while ago, that the balance has to be shown in the tax return as on the calendar year ending for respective year as on 31st December. Now, another point which Schedule FA has a financial interest in any specific entity outside India. So in this particular tab, that the name of the country on which particular entity you have the interest, whether you have beneficial interest, whether you have legal owner or etc., that has to be mentioned. Now the main point in this particular schedule is that what type of, whether we need to report any total investment, and at what cost we have to be mention it. So in that case, if any person have any financial interest specifically in any entity outside India, he or she must record that total investment at cost value, and that again has to be converted into a Indian currency rupees, and the same the foreign exchange rate, which is a TT buying rate, has to be applied. Coming to the another point, if someone has the immovable property, that particular non-resident still have some immovable property outside India, then again that information related to that immovable property has to be captured in this particular tab, where he or she has to mention the name of address of that particular property and what type of ownership he has, when he has acquired that particular immovable property outside India, what are the investment value he has done, whether still he or she is getting some income from that immovable property. That every information has to be captured under this particular tab of FA schedule, which is a part C of FA schedule. In part D, he or she has to mention information in relation to other capital assets situated outside India. So other capital assets means specifically mention any financial assets, but that does not include any stock or any financial assets which are recorded in the balance sheet. So one must very careful about in relation to the capital assets, that it does not include any specifically assets which held as a stock and anything which is held as a business assets. So rest other assets has to be mentioned under the capital assets account, category, which is point D in FA schedule. Now, this become a more major attention in relation to a signing authority. Generally, you will find that a person who is a senior uh, person or a non-resident who become a resident in India, they are still having a signing authority outside India, and then in that capacity they are still signing the document or a particular information on either in a digital way or in a manual way. So whether we should report that information or not. So here, even though if you do not earning anything in relation to that particular transaction, but assessee will still have some signing authority lying with him, then in that relation he or she must have in provide the information in relation to that in tab E of schedule FA, which talk about again that information has to be given on the calendar year ending as on 31st December 2021, and all the information in relation to that particular institution where he or she having the signing authority has to be given, the address of the institution has to be given, in which country it is having, nature of the account, etc., account number, and again the peak balance of investment, which we have earlier discussed, that the peak balance of particular investment by that institution, that has to be funds converted into Indian rupees based on the SBI rate, which is a TT buying rate, and the peak balance will be the investment date or the during the particular calendar year, whatever be the higher, that has to be reported. And in case if institution earning specific income in relation to that particular investment, that income has to be specifically mentioned, and the nature of income has to be explained, which is similar to a earlier point that if that non-resident is earning any income, he or she must have disclose that income and provide the nature of particular income also. And when you are going to offer that type of income, if you are earning from that investment, say example you are earning a dividend income, so similarly that dividend income separately is going to be reported into the different schedule wherever that income will arise. So if it is pertaining to a income from other sources, it will go to a schedule OS, and if it is pertaining to other schedule, so it means that whatever be the investment a person is having a income, that has to be mentioned here. You have to be specifically mention here the nature of that income, and then wherever that income is going to be club, we have to be show that particular income in that particular tab also. It doesn't mean that if you have a dividend income and you report in a FA schedule, so it will not going to report into the income from considering that is an income from other source. So you cannot report, you should report a parallelly. We'll be covering that particular point, that if FA schedule has been captured by the SSC completely, whether he or she has to mention that particular information to other scheduler also or not. So instruction is very clear, which specifically says that you have to share the information in FA schedule, whereas the taxability and other component where you are going to offer that income, that separately has to be shown under the different tab of the income tax return form. Now, another point is generally those non-resident who come back to India, they are still having some trustee or in the capacity of a beneficiary or a settler in a trust. So whether that in that particular information they have to share, yes, they have to share that information also in the tax return. If any trust which is created outside India, and if they still hold the in the capacity of trustee, beneficiary or settler, they have to provide the information in their tax return, mentioning in which particular country they are having this type of trust, name, address, and the respective other information. And again, on this particular trust, if they are having some income in relation to that, again they have to show this in particular this particular tab, specifically mention the nature, and whatever be the type of income, that income will be going to sit down and specifically mention into a respective schedule, the as we discussed earlier in the earlier particular tab. Now, in this particular point, here the law has specifically mentioned that any income, generally most of the income which we have already talked in initial dialogue, that the generally income is a rental income, property income, or you have some capital gain related income, that will be captured under the earlier tab of schedule FA. But still, if there is a specific income which has not been covered under the schedule, then that particular income has to be specifically mentioned in in FA schedule in part G, where if you are having any foreign source of income, so which has not specifically covered under the earlier tab, and the rest of the information has to be shared in column in tab G of the schedule FA. So let's understand what are the key considerations we need to take care in relation to filing a FA schedule. So the first point, we put down emphasis in relation to a peak balance, so that the peak balance, whatever appearing in your bank account or a custodian account, that has to be converted into a Indian currency rupees. And then Indian currency rupees, you need to apply the exchange rate. Exchange rate will be the rate at the date on the peak balance will be high, or at the date of investment, whichever high. We will talk about on this particular aspect of peak balance later on in a FAQ schedule section, where we will talk about with an example that if someone has invested some some amount in euro, say example in 2015, and whereas today's my balance has increased, or my the rate of the exchange has been increased, so what peak balance we has to adopt. So we will talk more about in later part of the session. the TT buying rate has to be applied, and again it is via a SBI rate which has been prescribed by the SBI, which has and then investment cost, whatever be investment either in the shape of your trust or any other category which is mentioned under the FA schedule, that has to be converted into the Indian currency rupees. Now there is an exception has been given under this particular law, that if an individual who is a not being an Indian citizen, who is in a India on a business or an employment or any student visa, and if he or she acquires some assets during the previous year when he was a non-resident, then it is not mandatory to report any information under the FA schedule. So here the condition is that individual, he or she should not be an Indian citizen. If he is an Indian citizen, then it will not apply. So in case of he is a non-Indian citizen, and he came to India for a business purpose or any employment or any student visa, and during that period, and when he was a non-resident, he is not supposed to file any information if any income occurring to those particular assets during that previous year. Now this particular point which I just discussed, that in case if particular person fill out the information of schedule FA, whether he or she has to mention that information to other schedule, yes, answer is yes. He or she has to specifically mention the detail in schedule AL, which talk about each type of category of what type of assets he will be having, what type of income he will be earning. So one must have to share the information in schedule FA as a disclosure requirement, and the consequence or whatever the income has been generated under different type of FA, that particular thing has to be reported under the different schedule also. So it doesn't mean that you report in FA schedule, it will not going to be reported in any other schedule. It will be correspondingly information has to be shared or mentioned specifically under the different schedule. Now we will now talk about the changes which has been done in assessment year 2022-23 tax return. We have done away with our FAR reporting, which is specifically a FA schedule in ITR, that what are the specific tab we have, and then what are the specific area need to be considered. Now let's discuss more about in relation to the income tax new return form for AY 22-23 for those non-resident who after repatriate back to India, what are the specific new amendment or changes will be applied to them. Say example, if that particular person having a capital gain in India or maybe in a foreign source based income as a nature of capital gain, then there are the 4 new specific disclosure requirement under the capital gain schedule. One is that he or she has to mention the date of purchase and sale of land and building. So please make sure here they talk about specifically in relation to a land and building. Any capital gain arising on a other area, that is not captured here. They specifically talk about land and building. Then in that case, the sale and the date of purchase has to be specifically mentioned. And another case which has been specifically mentioned in this particular change is the country as well as the zip code of the property where if it is situated in foreign country. That is a specific requirement which is incorporated under this new ITR form. Another point is that we have to provide the cost of improvement as well. So cost of improvement has to be provided under year to year wise basis. If say example, if he has purchased some property in 2012 and in a couple of years, maybe 2016, he has done some improvement. So we will be requiring the information of improvement on year to year basis. And then separately, there is a disclosure requirement of cost of acquisition, and if the provision of indexation is applied, if the case may be, then the specific disclosure in relation to the index cost of acquisition has to be mentioned under this particular tab or called schedule CG in relation to those particular transactions. So these are the new changes which is applied in case if that non-resident having a capital gain income, then if you are a non-resident, then you have to be make sure that you should have this information. And if it is pertaining to your client, then the client must aware about that before filing the tax return. This information in relation to the capital as such, in relation to the capital gain, one must acquire this information, because without this information, we are not, the schedule will not allow you to move further. So another point which is going to be applicable for AY 22-23 is, in case if those non-resident are getting a dividend income in the shape of 222E, that particular information is specifically mentioned under the tax return this year onward, that he or she has to mention that dividend income. So generally those non-resident, if they are in a very high stakeholder, where they are a trustee or maybe some senior senior tax assessee, then in that case it may be possible they have some dividend income in relation to that particular holding in that trust in outside India. So in relation to that, if they are getting some dividend income in the terms of 222E, that information is separately is going to be disclosed under the tax return. Another point is, which is applicable for 22-23 is interest accrued on the provident fund, where the no exemption is available. So from this year onwards, as we are aware about it, if there is a contribution by employee in relation to his in relation to his provident fund, which is more than 2,50,000 rupees, that particular, if he is getting some interest income accrued to that particular contribution, that will be taxable under the income from other sources. And in case if the employer will not contribute anything, then in that case the contribution will increase from that particular limit increase from 2,50,000 to 5 lakh rupees. So there is a specific information has to be mentioned under the income from under the schedule called OS, which is other sources, where this particular information has to be reported, that whether the particular person is getting any interest income in relation to this type of contribution. Another reporting requirement, a new requirement has been come out, which is called a new schedule called tax deferred on ESOP. So the government has, the department, our CBDT team has issued a specifically called ESOP tax deferred in relation to ESOP 2 or 3 years back. Now this year they made a new schedule called tax deferred on ESOP, which has a specific information requirement which has to be specifically mentioned in the income tax return in case if any assessee having this type of particular type of income. Now another major point which has been captured, or a new thing has been captured under this particular income tax return AY 22-23 is a relief under 89A. So generally what happened, that non-resident who become a resident in India, he may be getting a retirement benefit outside India, and in India we generally charge that such type of retirement basis benefit under the on the basis of accrual, whereas in the different jurisdiction there may be possibility that that retirement benefit will be taxable at the time of receipt. So it become a challenge in claiming a foreign tax credit. In India, you are charging that particular retirement benefit on an accrual basis, whereas in the foreign jurisdiction, this accrual benefit charge basis on the actual receipt. So the government has introduced a new tabs, new specific information in Schedule S as well as income from other sources, where we have to provide the information that in case if there is a gap in relation to taxation on foreign retirement benefit, then one must to disclose this information in both the schedule in the salary as well as income from other sources. And just to remind you that this is applicable from April 2022-23, from 1st April 2022 onwards. However, the tax department has not come out with any specific formula how to claim the benefit of 89A in relation to that. May be possible that we may come out this particular formula in a or a notification from the CBDT maybe very soon. Another point is, if that particular non-resident are getting a pension income. So generally that we will covering this particular thing later in our FAQ slide also, that if pension has been received, what he has to do. So first of all, he has to specifically mention the nature of employment, whether he is getting from the center government, state government, public sector undertaking, or others. So in the other column will be applicable in relation to a non-resident who is repatriated back to India, and if he's still getting a pension from his foreign company or maybe a foreign government, that particular mandatory requirement has to be mentioned under the tax return in AY 22-23 onwards. So he or she has to choose the option specifically that he is getting a pension and the category of the employment from which particular employment he is getting a pension. Point number 7, which is a more critical and required your kind attention, that from AY 22-23 onwards, there is a specific option has been given under the tax return, and all the provision in relation to your resident, non-resident, resident but not a resident, there are specific clause has been mentioned under the return that you need to select that whether 182 days category will be applicable to you, then you become a resident, or whether is 120 days or whatever be the condition mentioned under the section. So each category has been mentioned. We need to select the specific category that on which basis the person is becoming a resident or a non-resident, or resident but non-resident, and then basis that that particular selection rest of the form will apply. So here this is a new requirement, a suitable description on each particular tab has been given. So before going further, it is better and understand this particular requirement and take the right option under the tax return. Under that particular category, whatever be the category of days he or she will be fall, based on that the registration will be determined, and then return will be rest of the other form will be pop up, and what are the information are not applicable, that will be blocked. So it is a very important thing that before proceeding we must select very carefully this option of resident or status of a resident of the SSC. So these are the changes which has been impacted in the tax return for AY 22-23 year. Now we will take a next point, or a next agenda of this particular discussion is gifting of the assets. So generally what happened that when the non-resident come back to India, he or she may have some property outside India. He or may he or may he or she may have some money outside India, some shares outside India, or it may be possible he or she may give this particular assets as a gift to his particular relative. So we will discuss in a very high level thing that what are the scenario and under the what law that gifting is permissible or not permissible. We are not going to talk on the taxation impact as such. It is just given a brief very high level idea that generally between resident and non-resident, those non-resident who become after becoming a resident in India, what are the exchange of assets will be happen by way of gift. So before going to this particular topic, let's understand that relative have a definition under the FEMA as well as under the company income tax act, and whatever be the transaction apply in relation to a resident and non-resident, the FEMA law will apply, and FEMA law use the company act related relative definition. So please understand the we have to be link the relative definition under the company act while evaluating the FEMA provision. We will not going to discuss what under the income tax act the definition of relative is there. For relevance of transaction between those non-resident and resident, we have to consider the FEMA law, and FEMA law follow the company act. So company act definition of relative will apply in this particular type of transaction. And whereas relative which is defined under the act, they have given like your father, mother, brother, sister, son, daughter, son's wife, and daughter husband. These are the limited relative definition which is given under the Company Act 2013, which apply for all type of FEMA transaction, and accordingly that FEMA transaction we will be dealing in our income tax related things matters. Now, what type of different assets of gifting can be? It may be possible that non-residents having some foreign security outside India. And say example, the example we were discussing, a Dell share he has purchased, he or she has purchased. So it may be possible that that foreign shares or a security, they will sold out, they will give a gift to a resident in India, or they may be possible they can give those non-resident who coming in India, they give those foreign assets to another non-resident also. So we will discuss in gifting of assets a two scenario. One will be if resident give that assets to non-resident, or second scenario will be if non-resident will give this assets to resident. So it may be possible, and that is a category. Then differing of different type of assets will be like money can be given. There may be possibility of gifting of your property in India, property outside India, and shares. There are the major thing which generally gift of assets has been exchanged between resident and non-resident. Now let's talk about one by one more or in a detail that what type of exchange of gift can be happen between resident and non-resident. Now this particular table has been divided into a two parts. So left side of the table is talk about when the donor, we are talking about first of all is a gifting of money. In a money can be gift by a donor to a donee. So the left side of the table talk about that if donor is a resident in India and donee is a non-resident, so whether that resident can give a money as a gift to non-resident. So there may be a three situation can be possible. Number one, say say example, we put down with an example that resident Mr. Ram want to give a money as a gift to Mr. David as a non-resident. So if Mr. Ram want to give a foreign currency, so he can do, and he can give 2,50,000 per year financial year, a USD amount which is allowed under the LRS. And in case Mr. Ram want to gift money to non-resident in Indian currency, again it is also allowed, but a condition prescribed is that the non-resident should be a PIO relative of the donor by, and deposit should be made in a NRO account, and the limit has been prescribed which is a 2,50,000 US dollar. Now third situation will be if that resident with Mr. Ram, if you want to donate, if you want to give a foreign currency, whether it is permissible or not. So in that case, if resident Mr. Ram want to give Mr. David in a foreign currency as a gift, so that is not permissible transaction. So now that is a transaction between resident when resident is a donor. Now we will talk about in case if non-resident Mr. David, if he want to give a money to a Indian resident, whether he can give or not. So let's understand, if Mr. David, who is a non-resident, if he want to give money as a gift to a resident Mr. Ram in foreign currency, then it is allowed without any limit. And if non-resident want to give to an Indian resident in a Indian rupees, it is again allowed without limit. And if non-resident want to give a money to a resident in an Indian currency, then it is not permissible. So these are the situation of giving money between resident to non-resident and vice versa. The main condition is if you are gifting this type of money between resident and non-resident, then there is a situation that all this particular money will be owned by own fund. it should not be a borrowed fund. And the limit generally for a resident individual is $250,000 per year. Now, moving to the another situation, which will be a immovable property situated in India. So there may be possibility that someone has immovable property in India and he or she want to gift that immovable property. So there may be again a two situation, that in case if donor is a resident and donor is a non-resident. So let's talk about in case if the donor is a resident. If donor is a resident, Mr. Ram, and he want to give his particular immovable property situated, say example in Hyderabad, to a non-resident. So whether he can do or not, yes, he can do a immovable property as a gift, except any agriculture land, farmhouse, plantation property that cannot be given as a gift by Mr. Hello.
Yes, sir. In the previous slide, I have a question. Can I ask you?
Yeah, please.
Can you
This one?
please? No, the previous one. Sir, here resident to non-resident. No, the next one.
This one?
This
Gifting of
one.
money?
Yes.
Yeah,
Sir,
please.
here I didn't understand the difference. Two times it is coming foreign currency. And even in NRI to non-resident to resident also two times coming Indian rupee. So what is the difference? I'm not getting here.
Okay. So in first situation, if resident is giving money as a gift to a non-resident in a foreign currency, that is allowed up to a LRS limit, which is prescribed at 250,000 per year. But if resident, I think no, sorry, I think this third tab is an extra which has been wrongly been put down. Yeah, I agree.
Okay.
You have agreed. That is the first transaction. First tab of the particular 250,000 is a correct one. The third tab is not the right one. It has, I think, wrongly put down.
The
I apologize for
same situation is there in the next. The next
Indian rupees. Yes. Yeah.
In that also the third column we have to ignore, is it?
Yeah. The third column is irrelevant.
Okay. Here also in Indian rupee also.
Yes.
Okay, sir. Okay.
Thank you for highlighting this. I will definitely revise it and share is the revised one. Should I move further or any other technical doubt on this point slide?
I think no further doubts, sir. Please move on.
So another situation will be which we are discussing is in case of immovable property situated in India and that gift of assets has been exchanged between resident and non-resident, that what could be the condition, what type of immovable property can be given by resident or a non-resident as a gift. So in first category, which is a left side, which would, in case of Mr. Ram, which is a resident in India, and if he want to donate his immovable property, say example, sitting in Hyderabad, to a non-resident, Mr. David. So whether he can give that immovable property, yes, the immovable property can be given as a gift. The condition, the exception is agricultural land, farmhouse, and the plantation property that cannot be given as a gift to a non-resident. Now, in case of a non-resident, whether he can give a gift of immovable property which is situated in India, there can be a two situation, whether he can give to resident or whether Mr. David can give to another non-resident on the same jurisdiction or foreign jurisdiction or maybe a different foreign jurisdiction. So if Mr. David, which is a non-resident, if he want to give a gift of immovable property which is situated in, say example, in Hyderabad, situation one will be to a non-resident. So yes, he can give immovable property as a gift. The exception is again the agricultural land, farmhouse, and plantation property cannot be given. Whereas if non-resident want to give to a Indian resident, then any type of immovable property can be given, even though it is an agricultural land, farmhouse, or an exception property. And there are specific prohibition has been, not a prohibition, we can say there is an prior approval in case if immovable property is situated in India, and there are some specific neighboring countries, specifically like Pakistan, Sri Lanka, etc., etc. If they want to if they are a citizen of that particular country and they want to give a gift of a property which is situated in India, they want to take a prior approval of RBI. But in case, if for example, that Pakistan citizen, if they are a OCI holder, which is a very rare chance, then this particular prohibition will not apply. Now we will discuss about in case immovable property is situated outside India and it will be given by a resident or a non-resident. Let me discuss both the situation. Say example, if immovable property is situated in London and Mr. David and Mr. Ram, who is an Indian resident, whether he can give this particular immovable property sitting in outside India, which is example in our example is in London, whether he can give to, say example, Sita, who is an Indian resident. So there may be three possibility. Number one, if Mr. Ram has acquired that property in London, which is outside India, while he was a non-resident. So if that particular, say example, 15 years back, he's a non-resident, he has bought some property in London, and today he want to give to a resident sitting in India. Whether he can do? Yes, there is no explicit permission, it can be done. Another situation is that resident who's in India, if he want to give a asset situating outside India to an Indian person, and that initial resident person, he has acquired the property in accordance with the foreign exchange law. So in our example, Mr. Ram, who has buy some property in London and he has buy the property based on the London foreign exchange law, then again he can give to an Indian resident, to a Sita. Third situation will be that Mr. Ram has acquired the property, say example in London, on or before 8th July 1947, and still he continued to hold that property, even though that property can be given to another resident as a gift. Another situation, if that particular resident, if he want to give a gift or those foreign immovable property to another non-resident. Say example, in our example is Mr. Ram has some property outside India, which is in London, and he want to give that immovable property to Mr. David in visual non-resident. So yes, the condition is a resident is permitted to acquire the immovable property outside India under LRS. First, he has to acquire the property in London through LRS route, and after acquire, he can give this particular assets to a non-resident also. Another, now that is the resident situation. Now in case of a non-resident, say example Mr. David, he has some immovable property in London and he want to give this property to a person sitting in India, which is a resident in India, Mr. Ram. Whether he can do or not, for that he has to apply first of all a RBI specific permission to hold such property, or if he sell that property in London, then bring back the fund to India. In that situation, he can, non-resident can give that immovable property to an Indian resident also. Now we will talk about on the shares part now. Now if one has a foreign security, say example in our real example is a Dell India, in Dell Inc, if someone is holding a Dell Inc share in the capacity of resident in India, whether a resident in India who is holding a share of foreign security, for example Dell Inc, whether he can give that Dell particular share to non-resident. So in that particular case, the only security acquired under the LRS route can be gifted to a non-resident. Other than that, no security can be given to a non-resident. Whereas in the non-resident, if they want to give a foreign security to a resident, that is permitted, and there is no specific prohibition. A non-resident can give a gift to a resident as a donee of foreign security. Another situation will be, this will be a slightly a busy slide. I will try my level best to give you a very high level that in case Indian shares are given by non-resident as a gift, that what could be the whether the transaction are permissible or not, what are the reporting requirement, what are the secretarial cap. So let's understand this slide in a very easy way. First of all, non-resident India, they can hold the Indian shares in a two category. Number one, in repatriation basis, and another category will be a non-repatriation basis. So example, if non-resident is having some Indian share, the first category will talk about that if there is a repatriation basis, that the fund will be going back to the foreign country. In that case, if he give that particular shares to resident in India, or it may be possible he can give that particular share to another non-resident. So in particular first situation, non-resident who is holding a Indian share on a repatriation basis, if he give a gift to a resident in India, so first situation will be whether is a permissible transaction or not. Yes, in an automatic route, he can give a gift to a resident in India. What are the reporting requirement? The reporting requirement under the FEMA law is he has to report the transaction to a FC form called FCTRS, and there is no specific secretarial capital cap applicable in this particular case. Now, the reporting requirement on this all the transaction will be on donor or donee who is a resident in India. So law says that whether you received by a donee or whether a donor has been given, anyone can do the reporting requirement. Now another situation is a resident, non-resident, if on the reputation basis, if he want to give a gift to another non-resident, so whether it is permissible or not permissible, the situation will be if it's in a reputation basis on an automatic sector, it can be done. There is no reporting requirement, and neither there will be any secretarial cap is there. But on the non-reputation basis, it will be on an automatic route, it can be done. The reporting requirement will be there, and there is a no secretarial. So I leave that chart because that is more complicated. It can be referred when you have this type of scenario, because we will more discussing about the another part. So for the knowledge purpose, I put down this particular slide in a such a way that whenever you have this type of transaction or whenever you have client who are facing this type of issue, so you may be a very quickly took a glance and understand the what are the transaction are permissible in case of Indian share held by non-resident and has been given as a gift to a resident or a non-resident. So whether it's permissible or not permissible, reporting is there. So that will be one where someone can refer the slide and accordingly take a position. So now let's talk about on in relation to in case if those non-residents are after becoming a resident and after repatriate in India, they become a resident in India and they have some double tax income outside India. So what are the steps they need to generally need to take care? So in that particular stage, first of all, we need to check whether there is a tax treaty between the country of where the double tax income has been offered by those non-resident. And then for claiming the tax return, he has to, first of all, we have to cross check whether there is a double tax income under the DTA or as well as the under the Income Tax Act. So we'll not talk about more about what does double tax income is, but let's understand in a short way that the income which he has earned outside India, if that particular income is already offered for tax outside India, and again back when he, since becoming a resident in India, he has to pay tax on it that income in India. So the word has been used is, the term is double tax income. So he has already paid the tax outside India. Now he is on the same income as a global income. He has to pay tax in India also. So that particular term are known as double tax income. So if he has paid the taxes, we should have to encourage him to share the tax paid challan and the written copy and other evidence of the foreign jurisdiction where he has already paid the tax. And thereafter, that particular case, one must to file a form 67 to the tax office before filing the tax return. There is also a ambiguity whether, if someone has filed the tax return and form 67 has not been filed and it has been filed later on, whether the credit will be available or not. So the intention of the lawmaker is that the form 67 should be filed along with the tax return on or before the filing the tax return. So if someone has missed, so there will be a very less probability or chances that he will able to get the credit. So maybe the lawyer authority will not allow it. So he or she may to contest this particular matter, that if he is a mistake that he has not filed the form 16 on time. Maybe in a higher authority, there are some ruling where specifically says that if a delay or a default has been happened at SSE level, the genuine credit should be allowed. So, but we should encourage to our client or to the SSE or wherever the particular this case will be there, that the form 67 should be filed on or before the filing the tax return. And the another point is that particular individual has to disclose a part of the FA schedule, a schedule called FSI, foreign source income, and schedule called TR. So foreign source income has to specifically mention under ITR 2, whereas if anyone is claiming the tax refund, claiming a particular tax credit of foreign source income, then he or she must also file a schedule called TR also. So these are the specific thing which generally one should take care when there is a double tax income and the tax has been offered under the foreign jurisdiction. In such a case, form 67, form schedule FSI, schedule TR, these are the three things which specific attention has to be taken care. And then there is a very general question will come from our past experience, that most of the will say that we do not have any taxable income in India. Say example, if someone come back to India and does not have any income, and he said that my tax has been deducted in foreign jurisdiction, I want the refund back. So whether that refund can be claimed? So answer is no, refund is not possible. You can claim that particular tax which is deducted outside India either through a tax credit or a exemption method, which is prescribed under the specific DTA of the respective country. So either the exemption method or a credit method. Article 23 have a more detailed procedure that how you will able to claim that particular thing in your tax return. But there is no tax refund for such type of foreign income has been claimed in India. The basic provision, let's talk about that we should highlight to our those client or those SSC who are a non-resident. In such a case, they have to be adhere to the advance tax if their tax liability exceeding 10,000 rupees. So they make sure that there should be a proper advance tax payment based on the respective quarter, what are the installment has been prescribed under the law, to avoid a 234 ABC interest. Now, the general thing will be come by those non-resident if I don't file the tax return or if I file the late return. So what are the major consequences will be happen? So even though the interest exposure or your non-filing late fees are very less, 10,000 rupees, or if you are filed on a different time period game, but there is an exposure of your financial interest in relation to 1%, 1% of 234 A, B, and C. And then in case if any of the SSC is having some losses, that losses will not going to be allowed. So that is from the Income Tax Act side, whereas the major issue will be come from the Black Money Act. Black Money Act is specifically talk about that if someone has not disclosed their foreign income assets, So under the Black Money Act 2015, there is a penalty of 10 lakh rupees per year. That is a very serious amount and a huge amount, considering that that non-disclosure will have a higher repercussion under the Black Money Act compared to your Income Tax Act. So let's take an example. If someone has come back to India in 2022, and say example he stay in London for almost 15 years, and he has opened the account 5 years back in 2015, or 5 or 7 years back, maybe 5 years is around 2017. So Black Money Act, since the law says the penalty is a per year, so the maximum exposure under the Black Money Act will be a 50 lakh rupees for non-disclosure of the information for 2022. So it is almost encouraging thing that in case whatever be the information pertaining to the foreign schedule, which we have discussed very detailed, that FA schedule have 6 or 7 component, we must encourage to the those SSC that they need to represent this information and disclose properly with the help of chartered accountant to show this information. Else, a part of the tax consequences or a financial implication, there will be a several other law which have the implication. Now, under the Income Tax Act, a part of the interest and then specifically or delay filing fees, there may be exposure. The tax authority can go for a penalty in relation to that particular things that in 271C can be attracted. And again, another provision will be in relation to a failure or concealment of a specific imprisonment. So we should not encourage anyone to hide this information. It's always better to disclose the information to have a peaceful life rather than dealing with all this non-consequences. That will be a very severe one.
Sir, I have a question here.
Yes, ma'am.
Will this applicable to Indian resident as well who is having some, let's say, shares in Uganda or any other company? I'm just giving one example. One of the clients, they have some company incorporated in Uganda where they have been shown as a shareholder. The amount may be less. I mean, it may not be more, maybe 20, around, let's say 25,000, for example. But will the same penalty will be applicable to them also? Or are we talking about only?
No. What I understand that your client is a resident in India and he is having a share or some shareholding in Uganda-based company where 20,000, the value of the shareholding is less than 20,000 or approximately 20,000 rupees. Now, what we have discussed till time is this all provision will applicable when a person is resident in India. So example, your particular client, he was in Uganda for 5 years. Now in 2000,
here only.
In that case, if he is a permanent resident in India, that means the resident in India FA rule will apply. And now it's irrespectively whether the quantum of shareholding are 1%, like beneficial owner and beneficial interest specifically mention that you are having any holding in that particular institution, then that you are becoming a beneficial owner. So if you are classified as a beneficial owner or a beneficial or any legal owner, then on all situation you are qualifying to disclose this information. Now, where you have to show, you have to go first to FA schedule. Before that, you have to select a written particular form that I am a resident. Yes, resident. Do I have FA schedule is applicable? Yes, FA schedule is applicable. In which particular FA schedule you have to go? Then you have to check where you have the equity interest or a debt interest in that particular tab. You go there. I don't remember the number, whether it's 3 or 4. Then go to that particular number. Put down the entire information. In case if you do not disclose this information, so what happened due to the exchange of information or the treaty have a exchange of information clause. So generally the tax office between both the jurisdiction, they share the information on very frequently basis. They have specific time period also. So in case if a tax officer will come down to you and they will mention, we have seen that particular case also in past also, where they have come down and they have mentioned, like in your case is Uganda, we found some specific case where they say mentioned you have some interest in Japan based company, but you have not shown the in your tax return. Why not this 271C will apply, Black Money Act will apply, and rest of the other provision will apply. So then you will not going to be done away that, oh, I just forget it or I have no aware about it. So because instruction are very much clear that if you are a beneficial owner, you are a resident in India, please disclose in the information. There is no as such, this is only a disclosure requirement, but if you don't disclose, then it become a challenge. There will be
But
no any.
when,
Yeah, please, ma'am.
when they invested, let's say 25,000, for example, they invested at that time, they might not have taken any permission if at all required.
No, madam, actually the transaction value, there is no materiality concept in the shareholding or a beneficial. It is a concept. If you are holding a 1 rupee share or a millions dollar rupee holding, if you are qualified as a beneficial owner or a legal owner, then the reporting requirement is there.
So can I
like
start doing reporting in this financial year 21-22?
absolutely. If it is there, you should. We have seen a very big promoter where they were not aware about it because a tax return filed by their chartered accountant, and they have not shared the information to the chartered accountant. It is not the default of CA, but the promoter are having a huge interest in a different organization across the world. And then later on that Panama Act and different act will be there where they can catch this information, because today's world is very dynamic. Anything can be possible. Our tax department just want that please disclose the information. There is no tax liability as such. So if you
Right,
have the
that's what.
information, we have to share this information in a right way only.
Okay, sir. Thank you, sir.
Sir, one more question
So-
in the chat box. Inoperative bank accounts outside India. Will the Black Money Act applies to NRA settled in India, which is not disbursed in ITR returns? Sir?
Come again, what is the question?
Inoperative accounts. Sir, you can view in
Non-operative
chat
account.
box.
1 second.
Wait. Excuse me.
Which one, madam? There are so many things happening.
Wait,
Maybe you
wait,
can
sir,
repeat.
wait.
You can repeat your query. Inoperative bank account outside India. Will the Black Money Act apply to NRIs settled in India? So
Yes,
now,
sir.
yeah, we have to go step by step. Number one, when you are seeing the NRI settled in India, that what I am assuming it, now he become a resident in India. So he was earlier a non-resident, now he become a resident. So he is qualified for this FE schedule. Now FE schedule says that whether the bank account, whether it's operative or non-operative, it does not have a difference. It says that if you have a custodian of any account, you have to provide the information. Whether you operate that account or don't operate, law does not say. Law says that if you have a custodian account or any financial account there, you have to mention. So in that particular case, my response will be, it is advisable to disclose the information and specifically mention under the column 10 and column 11 that this is a non-operative, because there is no income arising on this particular information or account. But it is always advisable to declare this particular information if the condition of resident will be qualified.
Okay, sir. Thank you. And one more question, sir. We have deducted TDS of one deductee in the month of April, considering he is a resident. But ultimately, after completion of the year, his stay in India is less than 182 days and became non-resident. And what are the consequences of the situation?
Sorry. I think this is a
We have
different topic,
deducted
but
TDS
let me. You deducted a holding tax from any payment, which payment made to a
in the month of April, considering he is a resident, sir.
okay. So example, hypothetical, he is a contractor and you have withhold 194C tax in India on April month. What happened thereafter?
Then he actually stayed less than 182 days, so he became a non-resident. Assuming that deducted TDS, assuming that he is resident.
Okay. April month you have
But
withhold the tax
he is
considering
actually
that
non-resident.
okay. So let me phrase the question what I able to understand. The fact of the question is this, that you have made a payment in the month of April to a particular person who is a resident in India and you have withhold the tax. And say example, in the month of by the end of the year, he become a non-resident, he moved to outside India. Okay. And then once he become a non-resident and become outside India, and I'm assuming that this is a contract transaction or a professional transaction. So let's go back to a basic provision of that particular section. So section 194C or 190, say example, in our case is a 194C, that in 194C, the tax withholding will apply considering when you are making a payment any sum to a resident person. So basis that you have withhold tax at the time of credit, payment, or a suspense, whichever is earlier. So you're complying with it. You have done the compliances, and the April month and the May month, you subsequent month, you have made the payment. Now, if that particular person later on become a non-resident, move to outside India. Say example, he moved to outside India, or maybe possible hypothetical, he die in the next month. So it doesn't mean your transaction become invalid, because your first transaction per se at that time, his status is resident. So basis of his resident status, you cannot change your tax books. Your books of account will be already freeze for the month of April. So you cannot modify your books. Your position or whatever the transaction you did in the April month is completely right. It is the later on the person has changed the jurisdiction or person has changed his residential status. That doesn't mean that you have to completely forego your accounting, your internal tax position. So you need not to be do anything in that case if the person become non-resident.
Thank you, sir. And one more question, sir. NRA income to show on the basis of calendar period or previous year basis? Actually, NRA form 16 is in calendar period.
So for that, let me come back to this slide, because the point which you are talking about earlier, there was a challenge to understand the accounting period. Now the law has specifically done away with the accounting period for FAR schedule. They are saying the calendar year ending on 31st December. So example, we'll take a more example in this particular case. Like in this particular example, what we are saying that you have purchased some information or you have some income. Instead of purchase of share, you have some income in the month of January 21, whether you will going to report or not. So law has amended. They are not talking about anything now for accounting period. The law says it has to be calendar year ending 31st December 21. So our calendar year means our previous year is 1st April 21 to 22, which the return we have to file. But what you need to be consider, you need to consider 1st January 21 to 31st December 21. If that income will fall under that particular calendar year, irrespectively whatever will be the jurisdiction you are having an income, they will have April to September or September to August, whatever be the period they are having. If basis of the calendar year, if any purchase or any of the transaction report under FA schedule, then we have to disclose this information. Earlier was, before this particular year, there was concept of accounting period. That is the reason the confusion arose. Now the law says, lawmaker make it clear it, for the previous year, please consider the calendar year. If anything which we have discussed in FA schedule, if fall under that particular calendar year, please disclose.
Okay, sir. And one more question. When a resident SC discloses voluntarily his interest in foreign asset before finding out by the department whether penalty can be waived under PMA and IT Act.
Madam, it's a very judgment thing, and I will give the reply in a such a way that is depend on the mood of the tax officer. Generally, generally, you can we have seen that penalty if if the suo moto non-default has been done, then we'll not have any favorable thing. But if a genuine mistake, or if SSC was not aware about it, and there may be both the situation will be happen, but we'll see if it's in a genuine case, the penalty generally will be dropped. But I'm not saying it's a standard thing. However, I have seen that if reasonable views or reasonable explanation has been given, the penalty will be released specifically in Income Tax Act. However, the Black Money Act, the law is very new. They have not have any precedence in relation to giving a relief for Black Money Act. So that is the main reason that our institute has specifically talk about on this particular reporting that we should appraise to your client or a particular assessee who are under this category that disclosure requirement under tax return will not have any financial implication, because you have not to pay any tax on it. But if you don't disclose, then the other law will follow, where you cannot take a guarantee that the Black Money Act officer will done away with your plea that you are not aware about it, because it is law of the land. We have to apply. Income tax, we have still so many precedents that if a reasonable mistake, then benefit has been given to the assessee. I hope I am clear to you.
Yes, sir.
So can I move further? I will not take more
One more
time.
question, sir. One more question.
Yeah, please, ma'am.
Whether
Yeah, please,
money
please.
to be donated or given loan should be own money.
It will be. I have covered that particular point, that if the money has been given as a gift, so it should be through our own fund. It cannot be a borrowed fund. I have specifically let me go to that slide again. That if gifting of money is happening, the last line is the remittance under the IRS for the gift have to be out of own fund only. It cannot be through a borrowed fund. Should I move further, ma'am? Hello, I am audible.
Sorry, sir. Yes, sir. Software license fee paid outside India through credit card without getting 15 CB, whether BMA will get attracted.
Whether
BMA,
what is-
BMA, Black Money Act.
Come again, what is your question? If you make a payment of software,
License fee paid outside India through credit card without getting 15 CB,
okay,
whether
then
Black
whether
Money
the-
Act will get attracted.
Madam, Black Money Act is a very wide. Actually, if you are not withholding tax, that will be generally covered under your Income Tax Act. Say example, I'm just for hypothetically assuming that this transaction is taxable and the tax has not been withhold and the remittance has been made. So first of all, the other law like FEMA and Black Money Act are different, whereas my Income Tax Act says that if the tax has not paid, the expense is going to be disallowed under the law. But the Black Money Act is majorly specifically apply where a disclosure has not been done, or where the transaction are in a such a way which is on a sham in transaction. But if non-compliances in one particular act, that does not mean that it become automatically what you can say coverage of the Black Money Act. So per se, we need to, based on the fact it may be a different view, per se it should not be that Black Money Act will apply when you are not doing a withholding tax. The linkage between, as of now, to my understanding, between Income Tax and Black Money Act is if there is a non-disclosure, and if someone is holding or having some income, and even though that has not been disclosed, or it may be some jurisdiction which are a heaven basis, and if structuring has been done in such a way, or where the GAR provision and different type of things provision are will be there, then then the Black Money Act will apply. But it does not per se in relation to your what you can say non withholding of tax will apply a Black Money Act. So that may be a mixed apply, that it based on fact to fact basis, but principally it should not apply a Black Money Act on that type of transaction.
Okay, sir. Thank you, sir.
So that is the last point in relation to those non-resident after repatriate. What are the general query they will be having? So let's talk about one by one. So in case those non-resident have them stacked foreign company stock, let's understand what does this stack foreign company stock means. Stack foreign company means is, say example, if you are a big shot where your portfolio is held or managed by a broker, generally where a very rich person, they generally do that, the portfolio is managed by the broker. So example, if those non-resident having a broker who maintain their foreign shareholding account outside India. Say example, in US, they will manage their account, they will buy some share, they will sold some share, and they will get some commission, and but it will not bear the name of the non-resident who is coming back to India. So the question will arise whether those particular transaction which is done by the broker has to be shown under the FA schedule or not. So the answer will be yes, because it has been done in the capacity of your non-resident, because non-resident has given a power of attorney to that broker that you maintain my stock, you manage it, I want this much of profit, or this much of the maximum thing I want. So in that case, since it has been done on behalf of that particular individual, the information has to be shown. Now another situation will be that another question will be that whether we have to report in point A1 whether it's a foreign depository account, foreign equity or debt interest related schedule, which schedule we have to mention this information of broker account. So because it is not a depository account, it is a equity which is held by a individual through a broker. So it will be going to report in schedule A3 of FA schedule. This is not going to be reported in A1 schedule. Another situation will be that in case if someone has vested shares through investing through a vesting mode, so do that particular information also going to be report in the FA schedule? Yes, if someone is having a equity share in foreign jurisdiction through a vested mode, that also be going to be report in FA schedule. Again, it will be part of A3, which is a foreign equity and debt disclosure, which has to be shown under the FA schedule. Now, another situation will be on a acquisition date. So generally it happened that like, say example, if some of the employee who have come back to India from foreign jurisdiction, and he has awarded some stock, say example, in January 2015, and he has vested the stock in the January 2022. So whether January 2000 date lane has to be considered, or a January 20 date of when stock has been vested has to be considered. So the law is clear that acquisition date need to be considered for the date of allotment only, not on the vested period. Now, the peak value of investment. So we have discussed in a FA schedule where most of the time the peak value of investment has been mentioned. So what does it mean? So example, say example, someone has purchased a foreign share of 500 foreign share in euro currency. At that time, the euro was 85 euro in 1920. Now, whereas in the current year, the rate of euro has been increased to 120. So the investment date is in the year 2019, where during the year that particular investment rate has been moved from 100 to 120. So what rate we need to be consider? So the instruction is very clear. The maximum value of the investment in the current rate has to be considered, which is year 2021-22. So that rate need to be applied by the SBI buying rate. Another question or scenario maybe come in the peak value of investment. Like, should the peak value or the closing balance determine on the basis of share price, or it should be just an investment made? So it may be possible you have purchased so many share of 50 or more than 50 companies, or you have to consolidate amount have to be shown, or a share by share. So it is clear that we have to share the information by share. It is not the consolidate amount we have to be mentioned in relation to a peak investment. Another situation can be that, say example, that particular non-resident, he came back to India and he has the shares, say example, in European market, and but he has not received any dividend from those shares during that year, but still he is holding that particular foreign share. So whether he has to report this information? Yes, he has to report again in the foreign equity related particular tab. Another situation could be that whether in case if he received the dividend, so whether we have to report the dividend also? Yes, as a general principle, we have to show the dividend under the income from other schedule, as well as in schedule D of part D of schedule FA. And now again the question will come another in the case of a dividend, that whether the dividend we have to share on by share or consolidate amount. So since we have to show the investment one by one, so similarly we have to show the dividend for each acquisition of share. Now there may be possibility that someone has a foreign income, like the income in India, there are some income which are exempt. So do we need to report such particular income which is accruing from source outside India? Do we need to report, or do need, or so answer is yes. Even though you have a foreign income which is exempt in nature, that information is again to be shown as a mandatory things under the tax return. Now another situation could be the ESOP. Say example, if that particular non-resident got the foreign share through a ESOP mode. So situation one can be that, say example, if he is acquired the US listed share which individual got on a ESOP every quarter. Say example, on 2008-9 he got on a quarter to quarter basis some particular share through a ESOP. Now do need to report every transaction separately, or it can be declared entire value, or even though there is a no transaction made during the year, because the transaction happened in 2008-9 and we are sitting in 2022-23. So do we need to report that particular transaction? Yes, because the law specifically mentioned calendar year as on 31st December 2021 for year 2022-23. So it doesn't say that acquired during that particular year. If you are holding the particular thing during that calendar year, the information has to be shown under the FA schedule, irrespectively whether the share has been acquired earlier in past also. Another situation could be when the acquired foreign share under the ESOP in each year from 2019 to till date. Say example, from 2019 to 2022, every year some ESOP has been granted to employee. Now question could be whether we have to declare all for holding with the acquisition date with the peak value investment, or only the share acquired during the year has to be reported. So here we have to report the share on the date of acquisition and report of each date of acquisition. It doesn't mean only the current year, it has to be for all the year. All information has to be reported under the schedule FA. Now in case if the SSC is a US based non-resident who is coming back, so generally in US there is two investment structure happen. One is ROTH and another one is 40K account. So both this account, like similarly like we have PF or ESI in India, more or less you can term that in US a similar terminology or an identical way of understanding that they are a similar investment instrument in US. So whether that information has to be shown under our tax return, answer will be yes, we have to show, because it's an instrument of investment instrument, and it has to be shown under the FA schedule if it is if it is qualified as a resident, which is a precondition. And another situation could be that if someone does not have any foreign any taxable in India, but still he has some income outside India, or a foreign based income, or some foreign holding, whether it may be possible he will say that I don't have any taxable in India, I'm not eligible to, and I'm not eligible to file tax return, my precondition is not fulfilled, what I need to do. Even in that particular situation, the lawmaker has specifically mentioned that we need to, that particular type of assessee, he has to show his tax return and show the foreign assets under the income tax return, even though you don't have your taxable in income in India. So that is the main thing, that the requirement or disclosure of all foreign assets or a source income has to be very clearly should be mentioned under the tax return, irrespectively what are the taxability or a tax income you have in India. The disclosure requirement isn't a mandatory, we cannot avoid, we have to show even though you don't have any taxable income under the act. Now, generally happen that if you have a foreign source income or assets, what you need to do. So as we have already discussed more in detail, the three schedule which is generally will apply. One is schedule FSI, schedule TR, schedule FA. FSI will be more or less when you have foreign source income like capital gain, some house property. Then ITR 2, we need to specifically put down the information under the FSI schedule. Under the TR schedule, that will generally apply when you are claiming a tax credit for the foreign tax which has been deducted by the foreign jurisdiction. And as we have discussed in earlier slide, that while not filing the tax return is enough, parallelly we have to file a form 67 which is on or before the tax return. We have to file for form 67 for claiming that particular foreign tax credit. And another schedule is a FA schedule, which is we have already discussed well in detail, that if you become a resident and having any foreign source or income, then disclose everything under the schedule FA under the category you are having it. And now another important point is the pension. It may be possible that non-residents, once he came back, he still gets some pension from the foreign employer on foreign government, and he does not have anything in India, he gets that particular pension income. So in that particular way, that whether the reporting has to be done under the tax return, answer is yes, that even has to be specifically mentioned. And this year the law has specifically modify the tax return where other category of pension has to be specifically mentioned if it had not been received from the Indian government or central or PSU, etc. But if it is received from the foreign party or foreign employer or government, it has to be shown under the category called pension others. Now, general thing which is even not linked with this particular topic, but most of the time we get to know the question from those who say that whether we have to pay the tax on foreign based pension which we are receiving from outside India. So generally pension as a thumb rule is taxable under the act. However, there is a specific clause under the respective DTA, clause 18. So one need to examine it, clause 18 of the respective article, whether the benefit of any exemption from tax on foreign based pension can be availed by those assessee or not. So one must keep in mind before claiming this, before paying any tax in relation to the pension of foreign based employer. So one must evaluate generally article 18 will cover the pension article. So basis that particular article, a position can be taken whether it will be taxable in India or not. So I believe this will be the last slide. So this is from my side, and now I left with very few minutes for question and answer. In case if anyone's have still more doubt, I'm happy to address.
One question, sir. How to show bonus, split and rights issued in case of shares acquired outside India? Is there any provision exist for reporting?
Bonus from the foreign uh, employer.
Shares acquired outside India, sir.
You are talking about bonus or shares?
Bonus shares. Bonus
Bonus
shares, right
shares.
shares. Yes, sir.
Yeah. So if the bonus share or any other share like ESOP and other thing, generally bonus share will be like as a when you have a foreign equity, like when you purchase that particular share, you have to show that information. Similarly, for the bonus, in case if you are getting it, you have to show under that particular foreign equity and debt interest related particular tab. That information is also going to be disclosed, because when you are it is a disclosure requirement. We are not talking, the law is not talking as of now that what would be the taxability when you are going to sale, what would be the cost of acquisition, etc. Today they want that if you have any holding either original way or to a right issue or a bonus issue, please disclose if it is fall under that particular calendar year.
I think no further questions, sir.
So
Please-
please.
Please guide on first balance sheet.
Yeah. So on first balance sheet, generally what happened, you will be, that is view a very high level view that in relation to a first balance sheet, it is depend upon that what type of income generally those type of SSA are having. If they are still having some foreign based income, then accordingly your debit and credit entry will follow. But in case if there will be only a like some trust or some other beneficial holding or some interest they are having, so as such there is no requirement to prepare the balance sheet, because the balance sheet will be based on your accounting principle that what you are getting or what you are paying it. So balance sheet follow when you are have some source based income, and it is more or less in a recurring nature. But if say example is on a one time particular transaction and you are getting a dividend in a one year and there is no other transaction, then there is as such no specific requirement to prepare balance sheet and disclose. But if you say example, if SSC who has some property outside India, like we have discussed in immovable property outside India, inside India, and then accordingly you have to prepare the complete balance sheet, and whether the income has been generated accordingly, the P&L and balance sheet has to be prepared. But if generally I found that most of the SSC they are having either a foreign income or they will having a specific beneficial interest or a legal interest in the foreign jurisdiction, and most of them they are not aware about it. That is the reason the Black Money Act and other thing will be happen. And you have seen that the trend of last 5 to 6 months, the Black Money Act or other the team of that particular team, they are raising a very notice to a very high taxpayer. That is the reason that it's better to disclose the information. Per se, the balance sheet will arise in a summary. Balance sheet will arise when you are having a particular assets in the foreign jurisdiction, and then still you are on generating the income.
Can you please stop the share screen, sir? So that thank you. If no further questions from the members, we'll go for closing remarks. Thank you, Rastagi sir, for having an excellent deliberation and going to deep insights of today's topic, particularly more enlightening our members on how to report NRI income or assets in ITR forms and updating us on the latest changes in new ITR forms regarding above, and also how to give the tax assets and double taxation aspects and consequences of non-disclosure of the foreign assets. And you have definitely our members will have benefited out of your session. And finally, thank you all the members for your active participation for all the 3 days and making the grand success. We request you to continue our support for our forthcoming programs also. And also members, we are planning to host physical national conference in the month of July, and flyer will be released and shared to you all soon. I request you all to have great participation for the conference and make it a grand success. Thank you one and all. We are signing off today. Thank you.
Thank you.